The American real estate market has long been considered one of the safest and most reliable ways to build wealth. For decades, investors, homeowners, and institutions have trusted property as a stable asset that grows in value over time. But beneath the surface of this seemingly strong market, several hidden risks are quietly building. Many of these risks are not widely discussed in mainstream financial conversations, yet they could significantly impact homeowners, investors, and the broader economy in the coming years. One of the most important risks comes from rising interest rates. Over the past few years, borrowing money has become significantly more expensive. When mortgage rates rise, monthly payments increase dramatically for new buyers. This reduces affordability and pushes many potential homeowners out of the market. As fewer buyers can qualify for loans, demand begins to weaken, which can eventually put downward pressure on home prices in many regions. Another hidden risk is the growing gap between home prices and household incomes. In many American cities, home prices have increased much faster than wages. This imbalance creates a fragile situation where many buyers are stretching their finances just to enter the market. When people spend a large portion of their income on housing, they become more vulnerable to economic shocks such as job loss, inflation, or unexpected expenses. Investor activity is also quietly reshaping the housing market. Large institutional investors and investment funds have been purchasing thousands of homes across the United States, especially in suburban areas. While this strategy can be profitable for investors, it can also reduce housing supply for regular buyers. Over time, this concentration of ownership may distort pricing and create instability if large investors decide to sell properties quickly during market downturns. Another factor that many people overlook is the rising cost of property insurance. In several parts of the United States, insurance premiums have increased sharply due to climate risks such as hurricanes, wildfires, and flooding. In some areas, insurance companies are even pulling out of markets they consider too risky. When insurance becomes expensive or difficult to obtain, it adds an additional financial burden to homeowners and can reduce property values in those regions. Housing supply is often discussed as the main problem in the market, but the reality is more complicated. While some areas suffer from housing shortages, other regions are quietly experiencing oversupply in certain property segments, particularly luxury apartments and new developments. If too many units enter the market at the same time, rental prices can fall, and property values may struggle to maintain their current levels. Another hidden risk lies in the growing number of short-term rental properties. Platforms like Airbnb have transformed the way people use real estate as an investment. Many property owners now rely on short-term rental income rather than long-term tenants. While this can be profitable during strong travel periods, it also exposes investors to sudden changes in tourism demand, local regulations, or platform policies that could drastically reduce income. Regional economic shifts also play a major role in real estate stability. Cities that rely heavily on a single industry can experience rapid changes in property demand if that industry slows down. For example, technology-driven housing booms in cities like San Francisco or Austin may cool if tech hiring slows or companies shift toward remote work. When high-paying jobs move away or decline, housing demand can weaken much faster than expected. Another major concern is the potential impact of an economic slowdown. Real estate markets are closely tied to employment, consumer confidence, and credit availability. If economic growth slows or a recession occurs, job losses can lead to increased mortgage defaults and forced property sales. Even a moderate slowdown can cause housing markets to stall, leaving buyers and investors stuck with properties that are difficult to sell. The structure of mortgage debt itself also presents risks that many people overlook. While lending standards today are generally stronger than they were before the 2008 financial crisis, the overall level of housing debt remains extremely high. If interest interest rates stay elevated for an extended period, refinancing options may disappear for many homeowners, locking them into expensive payments and limiting financial flexibility. Government policies and regulations can also reshape the real estate market quickly. Changes in property taxes, zoning laws, rent controls, or housing subsidies can significantly affect property values and investment returns. These policy shifts often happen at local or state levels, meaning the risks vary dramatically from one region to another. Another hidden risk comes from demographic changes. The housing market is influenced by population trends, migration patterns, and generational shifts. Younger buyers are entering the market later due to student debt and higher living costs, while older homeowners are staying in their homes longer. These trends can slow down the natural turnover of housing inventory and change long-term demand patterns. Technology and remote work are also quietly transforming where people choose to live. The widespread adoption of remote work after the COVID-19 pandemic allowed millions of workers to relocate away from expensive urban centers. While some cities experienced temporary housing booms, others saw demand decline. If remote work continues to evolve, it could permanently reshape real estate demand across the country. Despite these risks, it is important to understand that real estate remains a powerful wealth-building tool when approached carefully. The key for investors and homeowners is not to assume that housing prices will always rise. Instead, successful investors focus on long-term fundamentals such as local economic strength, population growth, job creation, and sustainable affordability. In the end, the American real estate market is far more complex than it appears at first glance. Rising interest rates, affordability challenges, climate risks, investor concentration, and shifting demographics are all factors that could reshape the market over the next decade. By understanding these hidden risks early, investors and homeowners can make smarter decisions and better prepare for whatever changes may come. The truth is that the biggest dangers in real estate are often the ones people ignore, and paying attention to these hidden signals may make the difference between a successful investment and a costly mistake.